Can you guys hear me now?
Much better, bro.
Okay, perfect.
Good afternoon. How you doing?
Good afternoon. Pretty good. It's been a remarkable week so far.
It's what is it, like 15 days into the presidency, something like that. So it's a wild ride so far. It's gonna be like this for a while. I was hoping
Oh
if
yeah,
you'd let me start, we can just do like a big picture overview of where we're at, and then you can kind of take it from there with regards to price action. Is that okay?
absolutely.
So if we just kind of restrict our analysis to the period roughly like a few days after the election, what I'm seeing, and I'll kind of just reflect to you kind of my sort of amateurish view of that sort of price action, and then you can kind of like dig deep on sort of the auction theory, sort of, analysis of what you think is kind of happening. But just kind of looking at it from a cursory perspective, what I'm seeing is that so first of all, if we look at sort of like the fractals, you see on SPX, I just, do a wave 20 on the daily. It's kind of, going back and forth. And over the last like month or so, it's just kind of like hovering. It's basically choppy, right? You got things are basically moving from 5720 to a little bit over 6,000 immediately within a week. And then since then, it's been 5875 to 6125-ish on the SPX. And then in ES, I'm just looking at like, just the value area on the volume profile. And I'm seeing, between 5920 to 6100 on the marches. And also, if I look at like IWM from kind of November 10th onward to now, it looks roughly in balance. The Dow is roughly in balance, but at the upper end of the range, so maybe the greater likelihood of a new auction. QQQ is roughly in balance between 505 and 528-ish. SMH might be in a new auction down. It looks like that might be one an auction down. Same with XLU and XLY. On the other hand, XLV, which is healthcare and industrials, look like we might be going up. Interestingly, the equal weighted S&P, which is the RSP ETF, that looks like to me to be on an upper range of the P distribution. And similarly, energy looks like it's in the upper end of the P distribution. Everything else, I can't really discern much that's going on. We seem to be, in general, in a very sort of choppy market, very catalyst-driven, very news-driven market. A lot of people sort of reacting to the news, extrapolating. But I suspect that you're going to tell us, Milk, that it doesn't matter because positioning seems to be trumping all of that stuff. So I'm curious to hear your views on sort of like the DeepSeek news that came out. Everyone was extremely bearish, but then positioning kind of probably trumped it. Similarly, pardon the pun. And then also similarly, this weekend with the tariffs, at the end of the day, positioning seems to have trumped it as well. Um, and so that's kind of just broadly speaking, kind of like how I'm looking at things. And I'm curious to hear, how you see things. And feel free to, put up anything from your screen or anything like that.
Yep, I'll share my screen. I don't usually do this a whole lot, but
But does that seem like in line with kind of what, I'm sure you have greater, I'm more deep in the woods of like looking at individual names and, sticking to the fundamental stories and things like that. So you're much more, you guys are in general much more involved in sort of the day-to-day price action and what, the auction theory and what's revealed by positioning.
yeah, so there's actually a lot of structure to what's going on, and I wouldn't, in my professional opinion, refer to it as chop. As you were just
Great,
discussing with positioning,
great.
positioning does matter. And from your professional experience, with larger funds or institutional, they tend to leg in to positions, right? It's not like day trading where they're like, hey, we're going to allocate, 400 billion in this one position on one tick on the market. So when we look at
Just
futures,
quickly, when I characterize it as chop, I'm just saying from like a bird's eye view, just looking at like, the basic, it looks kind of like a mean reverting market between a range. So that's all I meant by that.
Okay, fair enough. Yeah, so even with the DeepSeek kind of sell off, the little fear, there was very much positioning in that. There was, I'm not going to call it front running, but there was value in the market, right? So we kind of see this in rotations in the market, and it very much matters like where fair value is in the market, just like with auction market theory. You know, when you have supply side or demand side, we have large interactions with that. So like on my screen right now, you can see how our retest back here, around 58.20 on ES, so it'd be about 57.90 on SPX. This was a large swing high rotation up on the market. And as you can see with like last week, even with the sell off with DeepSeek, you can see how even on the supply side, when we retested, we were unloading inventory to these willing buyers. And you can see value add down here at 59.52 to 59.0950, like we had on Monday, the sell-off, that absolutely capped our bottom. So our demand side positioning, this was an easy add. So we've seen that a lot on Monday with like NVIDIA and stuff like that. And that kind of speaks to, if we look at the macro view on like foreign markets on Monday, or even over the weekend, I think you were on Twitter Spaces over the weekend talking about, the possible implications of everything. But when we see a strong dollar in world markets comparatively to, foreign exchanges, so if their money is worth less compared to the American dollar, their buying power is reduced, and they have, there's several, it's more complicated than, what I'm going to say, but they have, they have to risk off on assets, their risk exposure. And there was some articles, I think like Unusual Whales put out, said all the sell-off money was from foreign markets, non-US exchange, which was some truth to it, but they didn't elaborate, or maybe didn't have the knowledge on it. But the strong dollar is what kind of brought that forward. They had to risk off on risk assets. And then we've seen the buying of that in the US markets, like mega caps, NVIDIA. I mean, that was bought up pretty quick. So we had a strong dollar to purchase, all those risk assets back.
Correct. And the mechanism by which typically that works, and some people like to talk about the causality, the strong dollar causes this, that, but I tend to think of them as sort of simultaneous things. So if folks, most other countries in the world, they deal with trade, and their trade is denominated in dollars. I think 80% of the world trade is denominated in US dollars. So either the price is set by dollars and they can transact in whatever currency, but in effect, the dollar anchors the trade price. And so as a result of that, in a situation where folks are, if they're fearing some sort of credit event, or if they're fearing some sort of uncertainty, what winds up happening is they want to pad their balance sheet with dollars. And so they typically and so what that results in is that the Dixie goes up, treasuries usually, treasury yields go down, treasuries go up, and quote unquote safe securities that are denominated in dollars tend to go up because that's what they put on their balance sheet. They have to do that because I don't know, just if you're Indonesian, you need to buy oil, in dollars. And so like, let's say 1 month down the line, you need something that's going to basically hold its value in dollars, because your own currency is going down against the dollars. You need to make sure that, you protect against that. And so that's what they do in those situations. So you're right on there.
Yeah, it's pretty interesting. It's kind of like what we've seen, not a direct comparison, but like long-term fund in the 90s, the implications that came forth from that, with having margin in foreign markets and margin calls and risk assets. There was a lot of lessons learned from that back then.
Yep.
And so like, like you were just talking about like swaps and stuff. So, swapping, debt through currencies, that has a big implication like we seen on Monday. So I fully
Correct.
expect, um, we're going to we're still in a bull market, so to speak. We're obviously going to have some retracement later down the line. I think when we look more into the China tariffs, that's going to have even a broader impact on the market depending on the outcome. So that could dictate, a swing down in the market or a continuation. And as you already know, we're kind of all-time highs or close enough to. When we start to see what happens with the tariffs on China, I think we have 4 negotiations in April. Right now, I think they're implementing the 10% tariffs, and then China's trying to counter with tariffs on like farm equipment, oil, coal, liquid natural gas imports to the US or from the US to China. So they're trying to kind of counterbalance, but their exports are at 3 times the exposure than the United States. So they're not really negotiating from a position of power. They have a lot more to lose, so to speak.
Correct. Correct. I think that I think in the long term, this stuff probably has a negative effect on our economy. But I think that Trump is primarily a tactician. That's kind of how he looks at the world. And from if he sees an advantage, he's pretty good at pressing the advantage. And so right now he's just looking at kind of like brass tacks and saying, okay, vis-a-vis, say, for example, Mexico and Canada, they have a lot more to lose than us by relenting on, whatever we ask from them. And so by threatening these tariffs from a tactical perspective, uh, they don't really have a leg to stand on. So tactically, they can kind of, maybe prepare for, something over a couple of years, but they have to relent. And I think that that's how he's going to play the game. He's going to roll up the kind of easier countries at the beginning. So you're going to, you're going to, Mexico, Canada. Probably next is going to be a few things in Europe. But what you noticed is that he started with a pretty low tariff for China. I think he started with 10%. Obviously, things are in flux all the time. But my read on this is that he's going to roll up the easier countries. Maybe Brazil and some of the South American countries are next. Maybe a few European countries are next until he finally gets to China, in which everybody's already rolled. So then China's in a much, much weaker spot vis-a-vis us. That's kind of how I'm looking at it.
Yeah, it's pretty interesting. And the whole premise of what's going on, just so everybody's kind of clear on why this is going on, is just as Trump kind of promised in his campaign. He wants to shift structurally the American economy from income taxing to tariff revenues. So it's to reduce United States citizens' tax burdens to pay for everything, to pay for the government, to pay for debt to tariffs. So he thinks that's the biggest benefit to helping the American public. And it's going to be a pain, right? It's going to be I don't want to say pain trade. It's not a pain trade. It's going to be a burden on the economy at first, just like with investing. When you take on risk, it's an uncertainty at first until it pays dividends down the line. So until that happens, there's going to be some flux in, one second. There's going to be some flux in inflation in world markets with the uncertainty until it all kind of comes to fruition. So if we kind of look big picture, if everything does succeed in how he's trying to format it, it could be long-term very beneficial for the U.S., but it's just going to be a rocky road a little bit until then, in my opinion.
I agree with that. I think that you know, the I agree that's what he will try to do. I think talked about Peter Navarro on the on the main channel, and Peter Navarro made a statement reflecting what you just said, which is the goal is to sort of replace income tax with tariffs. Now, the tricky thing with that is that unless you significantly reduce the size of government spending, that's just not possible because that would imply that we would on average have something like a 76% tariff in order to fully, one for one replace, income taxes with tariffs. So something's got to give, and obviously, Doge is making an attempt to sort of reduce the government. I personally don't think that that's going to happen. I think that these guys are way more powerful, the deep state, and the spending patterns in government are. We'll put it this way: I'm a little bit skeptical as to whether or not. I think it would be a good thing, but I don't think that they can do it. I think that a lot of this stuff is deep government programs that folks, whether they like to admit to or not, depend on. So I think it's going to be politically very difficult for Trump to sort of enact some of the cuts that he's looking for. But I think that that is what he's actually going to try to do. So regardless of how we feel about it, I think that the forecast is that that's what he is in fact going to try to do. And so that's how we should be thinking about, going forward with regards to the markets, right?
Correct. Yeah. And it's good to keep that in mind, for an overall perspective, since that's the goal. And just as you elaborated, if that happens, and it's going to be a very difficult road to try to make that happen. Is it feasible? It's feasible, but it's definitely going to take some major restructuring of government spending, like you were just saying, like kind of ripping everything down to the studs, and
Correct.
remodeling a lot of things.
And one of the frustrations I have on Twitter is people get stuck with what they think should happen versus just being a little bit more neutral and just trying to say what is likely to happen. Forget what you think
Correct.
should happen, just focus on what you think people are going to do, regardless of
Yeah,
what you think the outcome might be. And that's a better way to navigate the markets.
it is. It's like a if-then statement, if this happened, that can happen, and to be kind of unbiased, to a certain degree. Obviously you have your feelings or beliefs or perspectives, but trying to stay that neutral position, like, okay, what are the pros and cons that could result of what's happening.
Correct, correct. And focus on what will happen as opposed to what you think should happen. Because your cognitive biases as to what should happen, yeah, actually seep into your trading. So be careful of that.
Yes, and that's the biggest thing in trading, to obviously you're going to have kind of a bigger side bias, but you don't want your bias to skew what's actually happening. If you have a perception, like, like what I do with data, I say, this is a higher probability, but with a high probability, there's always a margin for it not to work, right? So you have to
Absolutely.
acknowledge that and be prepared for that.
Correct, correct. I think that a lot of people who may be starting out are focused on setups and focused on sort of getting their forecasts correct, which is great. I think that that is a good place to start. I think that unfortunately, for those of us who've been around the markets for a while, it's always going to be noisy. No matter how good you are, there's always going to be a substantial amount of noise in your predictions. And so, just cognitively and emotionally, just to be prepared for that, like you said, if you have a high probability setup might mean something like 60% chance of it working out, but that means that there's a 40% chance that it won't work out. And so to be prepped for that and to sort of have stops and mental stops and things like that, saying, okay, my my outcome, or what I was expecting, has been quote unquote invalidated, and just be prepared for that. And I think that that's oftentimes some things that people overlook. And so it's good that you're highlighting that.
And, to highlight on that too, when we talk about bias, is it of a structural form? Do you have, kind of a thesis formed on actual data or something that's real, not, emotions? And a lot of the time, how we can help curb that too is word choice. So what you speak is what you think, and then you kind of feel. So if you're using like words like pump and dump, or stuff like that, you're provoking emotions. So you're trading is going to be reflective of that. It's no longer thinking in terms of probabilities and risk management. And that's the issue I see with most newer traders that come in. The feelings aspect. So using word choice, thinking of things in terms of probabilities will absolutely help curb that in time.
Yeah, I think when I'm on Twitter Spaces, some of you guys might have heard me on Twitter Spaces. I'm on a lot of Twitter Spaces with people are trading. Some of them are day trading spaces, and a lot of times you'll hear the following refrain. People, I don't know, they do something, it doesn't work out. They'll say something like, "The market fucked me," right? And there's almost an anthropomorphism that's kind of imposed on sort of the market. The market's neutral; it has no opinion on you. There's no feelings. It's not out to get you in any way, shape, or form. But I think when you have that sort of feeling that you're sort of in an antagonistic struggle against this thing called the market, I think that can really sway your perspective on how you think about risk. So I would agree with you on that word choice, I think, induces a lot of unnecessary emotion on your decision making.
It absolutely does.
So,
When
just getting into like obviously the Trump, this is a very different administration from the Biden administration. I mean, I think, you remember the last time, like the crazy news flow that always occurred.
Oh yeah.
There's all kinds of conspiracy theories. Some of them are valid. There was actually an interesting article on Vanity Fair a while ago about how people, there was massive amounts of E-mini contracts coming in 15 minutes before, there was some sort of press conference that was sort of scheduled, regarding tariffs or regarding kind of trade policy or, some sort of industrial policy or things like that. So there's always this sort of this element, within the Trump administration, that there's other people sort of, that they're essentially kind of like pushing the news flow in order to sort of manipulate the markets. And that's part of, I think that's part of the regime that we're in. Um, and so I'm just curious to like when you kind of came into this weekend and you were thinking of, or you heard all this tariff stuff, what was your first thought, and how did you interpret kind of like the news flow and with regards to, how things opened on Sunday night, and how did you sort of navigate all of that?
Well, most simply, it was as to be expected. So as we've seen over the weekend and leading into, Sunday night futures open, we've seen the strong dollar. We've seen the peso, the Canadian dollar, everything fall against the dollar. So it was, already easy to kind of see that there was going to be some liquidation from foreign markets. So when we open up in futures markets like on Sunday for ETH session, majority of that is foreign market because obviously, the New York Stock Exchange and American markets are typically closed. So when we had that sell off, right before open, you can start to see the orders exchanging, like on my data that I use, and you could see how far down they pulled the bid and the offers were. I mean, it was over 50 points down. So I could see that pretty clearly, about an hour or half hour before the open. So I was expecting a gap down. I wasn't expecting it as much as it did, but a good 50 points on ES.
Got it, got it. So it was roughly in line with that. And obviously, have you changed any, I don't know, like any process stuff with regards to the, this different regime where, we get a lot of news that's coming in after regular market hours? Like oftentimes you'll see gap ups and gap downs. I just remember there were a lot more gap ups and gap downs during, the last Trump administration, and so far that's been the case. I mean, uh, is that jive with your intuition, or is it essentially the same process as before?
In essence, it's pretty much the same. So when we're looking at even in large news-driven events, a lot of normal retail thinks, hey, it's random. It's not random. Like as you can see in the overnight last night, when we had our China news, where did we go? Into our seller objective and where we had previous non-fair value, which is our demand side. So I already knew, on test of this, buyers will value add on test to this. And that's, exactly what happened. So, just like with chaos theory, certain perceptions think, certain things are random in the universe. There's always an order to everything. So even in these big shifts in the market, there's still order to it.
Right, right. I think it's akin to like how random number generators are generated in your computer. It's actually completely deterministic, but
Hmm.
seemingly it looks very random, right? Um,
Yes.
so it's kind of that idea. So in this case, the auction theory kind of gave you a sense, okay, unless there's a new auction, buying at the kind of at the seller's objective area, presents a very good probability of jumping back into, the fair value area of pricing. And so that's a high probability sort of, kind of trade. And obviously the risk reward is higher because, if it goes down below that, that would quote unquote invalidate the theory that we're going to jump back into fair value. Is that the way you think about it?
Exactly. Loss of our non-fair value, you know, that trade's invalidated. So you
Got
know
it.
where to manage risk at. So it's pretty easy to put risk on and say, okay, I have small risk below and higher reward above into fair value.
So what does that risk reward look like? I mean, it looks like it's like 10 to 1. Is that correct?
It's more than that. It's
Or not?
it's almost 70 points to risk. 10, maybe 10 points, depending on, what you allocate for your risk.
Right. So that's at least a 7 to 1 kind of
Or so,
RR, which is
yeah.
that's a fantastic kind of RR. Got it.
And,
So
and
when you have an RR like that and you're like even right 30% of the time, you're making outrageous returns.
mhm. Yep, it's very orderly
Okay, great,
and it's
great stuff.
consistent, like what I stream every day, we see it all the time, even on, Monday, like absolute order to everything, on a RTH gap. I mean, it was kind of massive, but this was just a huge demand zone on the market. It was going to get bought up. It would have taken something outlandish to even break through the bottom side. And just like, how we use fractals for volatility metrics, every day walking in, we have a predetermined high probability range on the day. And then if we layer it with positioning, it becomes pretty powerful when you compare both data sets.
I did want to talk to you about that. So we've been at this. I've been on RCG for a couple of years now, and I just want to, as you guys have just sort of layered tool upon tool upon tool. Before you were primarily looking at things via order flow, auction theory type stuff. Now you've layered in a lot of the tools that Russell has built on top of this. Can you say anything in terms of just intuition, or I don't know if you keep records on this, as to, how that's improved your, whether it's win rate or your risk reward, or, anything that you can kind of, I don't know, like that you've noticed about your trading that's changed over the last, say, 2 years?
Absolutely. Like, so we have like volatility metrics, kind of like how it's priced out on options chains, when we're looking at how far out, market makers are pricing in like IV. Well, we kind of have better tools, that with that in the system. So when we compare that in what we have, it makes a big difference. So if we know what's kind of priced in every day, walking in with market makers, like on our IV walls, they're implying that we're going to stay within this range for the day. And it's kind of rare that we break above. Sometimes every once in a while there might be a skew of data, so it's not 100%, nothing's 100%, but 95% of the time, we have a very good idea of what's priced in. And then if we look at kind of historical volatility, like what I put with the yellow box strategy, we know our historical range. So when we overlay those, we're like, okay, we know high probability what's going to transpire within this range every day. Then when we start to layer in positioning, like what I use with my other data models I've built, I can see where buyers and sellers have position, where's their fair value in the market, where isn't there, where can we expect a reaction from, and it comes like a narrative. So you learn to essentially read it like a book. And it's through repetitive behaviors, like on our positioning, that I know what the reactions are with a pretty high degree of probability.
And so I'm just curious, just from and feel free to kind of push back on this at all. As you kind of, do this, and you obviously having this sort of routine and doing it again and again and again emotionally gives you a lot more confidence in your process. So as you do that, do you slowly increase your positioning and take more risk, or how do you respond? Or is it everything still the same?
It depends on the situation. So one thing I kind of love with the whole Trump trade thing is when I can see that volatility coming in the market, I can leverage into a position when it's proven to work in my favor. So, it's just like adding into a position. Okay, I'm going to put risk on. And then, I'm like 5 or 10 points in. Okay, I can add more risk on, but technically it's not really more risk, right? I'm just increasing my position size and then adjusting my risk down. So if I happen to break even on that initial trade after already adding into, it's essentially becomes a zero risk trade for me.
So
So
you
I've done
increase the
that enough time.
position. So just to make sure, you increase the position, but you tighten the stop. So effectively, you're lowering your risk, right? Is
Correct.
that what you mean? Okay, got it.
Yep, increasing my reward and keeping almost the same risk. Yep, and bringing it into zero.
That's fantastic. That's fantastic. And like just overall, as you look back and you analyze your sort of performance over the last, I don't know, 2 years as it's kind of progressed and evolved with all these tools, have you noticed a substantial difference?
Yeah, I mean, the
You
more
feel
I do it, the more confidence. I don't like using confidence, but convictions, because I see the repetitive behavior over and over again. I know what to look for. So it becomes better and better over time,
yeah.
just like with any profession.
I have the same view. I mean, I look at things more in like my favorite is the Wave 20 daily on the daily. And so for me, I'm looking at individual stocks, and when things hit their sort of like 10% sort of limits on the Wave 20 daily, I feel much more confident. If I'm fundamentally also, there's a confluence between my fundamental view that I think that there's going to be some sort of reversion. So I've learned to sort of feel much more comfortable in those situations. Whereas before I would have just been thinking about the fundamentals. Now I look at the statistics of the price action. So that's been
It
helpful.
helps a lot. Yeah, when you can
So
shift into like probabilities and where you can manage risk with those probabilities, and it becomes a high probability execution, it does make it simpler and repetitive, like muscle memory, so to speak. You've done it enough times, you know what to kind of expect, if it works in your favor, it doesn't work in your favor, where to manage everything.
got it. And I just have one final question for you, which is obviously every day you've been focusing on ES, and I see, you have a dedicated sort of stream on ES. Do you yourself look at other instruments? Like, do you look at Qs? Do you look at, GC? Do you look at these other things, or do you just, you're very kind of focused and steady on just ES?
I mean, I specialize in S&P markets, so SPX, SPX futures, which is ES, kind of watch SPY a little bit. I mean, it's kind of reflective of the whole basket of everything, but I do kind of keep an eye on other markets as well.
Got it.
I mean,
Got
I think you have to kind of be diligent. Doesn't mean you have to trade them, but being aware of them, just like what we had going on with gold on Monday, you know, that was kind of a risk off. You didn't see, you know, a, a normal response on a sell-off, with the reaction of gold, silver, everything else. So, kind of seeing that, that's something to learn as well.
Definitely. And then like also like on FOMC days, I imagine you're looking at the 10-year in addition to the VIX to kind of give you information as to what's going on in ES, right?
A little bit, yeah. So one thing that's kind of important too is, the VIX is kind of respective of hedging. So when we go into FOMC or large events like that, you tend to see people hedge. Well, after the event, if they don't need that insurance anymore, what happens to it? It rolls off,
Mm.
right? So that's usually
Hmm.
when we see a huge reaction to like the upside. If we see the VIX roll off, we see that hedging rolling off, we get a pretty large response because we have market makers who are, delta hedging. So once they readjust for their delta hedging, and doing it via futures or SPX, they end up buying the asset once the downside hedging has rolled off, and that's pretty common.
Yeah, I mean that I began to look at a lot more of that, the information that's embedded in the options markets with regards to positioning. I know some people within Twitter, there's a lot of people that are looking kind of, Vanna gamma flows because, if you broadly like say what are the sources of flows in underlying stocks, it's flows from just broadly information like, passive flows that come in because people just want exposure to sort of equity markets. Then there's individual idiosyncratic flows because you think that company XYZ is going to outperform or you want to own that relative to other things. And then there's flows that just as a result of people needing to hedge options. So as SPX is the largest option market in the world.
Hmm.
And I'm sure a huge portion of ES flows are due to people just needing to sort of hedge their SPX options, right?
Correct.
So, barring nothing happening, theta decay and things like that cause, even if nothing happens, the hedge ratios change over time. And so that alone kind of results in sort of flows that have to come into the market. And so that's when people refer to sort of charm and Vanna flows, that's what they're kind of referring to. And so those flows also are substantial enough that people keep track of them. And for some markets, like SPX, they could represent the substantial bulk of the intraday flow. And so they can help predict where things are going to go. And I think you guys account for that for the most part by looking at like IV walls and things like that.
Correct.
So,
Yep.
you
So
know,
we have a pretty good purview on, what that positioning is, the reflexive amounts from, say, Vanna and Charm, just in a much different form. And, seeing where everything's kind of positioned in. And obviously there's more to it with the system when we're looking at that. Actually, I think
right.
I can throw up. Yeah, I'll do that. I'll throw this up. 1 second, I'll switch screens.
Yep.
So
That's
when
it.
we're looking at this, if we go into SPX and we go into our spread monster and load our options data, and we can kind of look at like today's, 0 DT, and then we want to go into our density chart, and you can see how we're populating some of this data. we can start to look at, some of the expectations of what's happening intraday. This is obviously much different than, what I pulled last night, but you can see the kind of collapse of IV becomes a much smaller range for the end of day versus like last night, IV was, greater expanded. So, using this tool, it becomes, very powerful in how we, compute where we see exposure at.
Interesting. So one way that you could use this is to sort of, if you're selling spreads, you can really sort of say, okay, this is the now I can leave my spread on because the likelihood of it blowing past these levels are significantly lower than they were last night, right?
Correct. Yep. Yep. You can, and that's part of why this is built. It's called Spread Monster. So eventually, when we move into like some of the live data aspects, you can click on here and actually build spreads, and kind of formulate all that. I'm gonna say it's more advanced than like Black-Scholes. Black-Scholes was traditional. It was, kind of great for its time, and it's still the kind of the market standard, but it has its many flaws too. It's based on, historical volatility repeating. It's not really factoring any outsized volatility.
Correct, correct. All of it, by the way, just so people know, all of this stuff that people have out there, like the gamma, Vanna, um, you know, uh, charm type of analysis, which is the second order Greek stuff that people do, it's effectively trying to account for some of the dislocations that you are talking about with regards to Black-Scholes. If Black-Scholes held in absolute, a lot of those things would not be that useful. But the fact that they go into gamma, charm, Vanna analysis means that there's obviously limitations to Black-Scholes. And I think Russell just looks at it in a totally different way, but they're sort of different languages to describe the same phenomena.
Correct. And there's a lot of funds that spend, tens of millions, if not, $100 million trying to build out these models to try and, factor all that data. So it's no small feat to do this kind of stuff.
Absolutely, absolutely. Yeah, the three biggest market makers, I think, are Susquehanna, Virtu, Citadel. There might be one more, Jump Trading, I think might be the other one. And they, each one of those are multi-billion-dollar kind of operations where they effectively, wind up making most of these markets. So interestingly
Yeah.
enough. Yep.
Yeah. I mean, even if you look at like Vanguard, they have 10 trillion AUM.
Yeah, I
So
know. It's crazy. They own everything.
yeah.
Them and BlackRock. Um, Interestingly enough. Okay, I've kind of, I think I've addressed a lot of the issues that we were going to talk about. Should we open this up to Q&A?
Yes, let's do so.
Okay. So how do you want to do it? Do people just write stuff in, or do people just request to come up, or how
Yeah,
do
we
you
can
want
have
to do
some people see, we can have some people request to come up, raise their hand.
it? Right. So if you want to come up, just raise your hand and we'll invite you up, and or put in a there's a side chat going on if you want to kind of if you want to hit the dialog box at the far upper right corner, you can kind of you can see the chat that's going on and pose a question there if you don't want to come up.
Let's see.
By the way, is there any other issues that you want to kind of address with regards to what's going on in the market right now?
I mean, if we're looking at kind of news-wise, it's kind of interesting looking at some of China's reactions, this morning, some of the news that came out, like with Alphabet, they're putting in, a probe into like antitrust laws, of Google, Alphabet, and China as kind of a response to the tariffs. And looking at that, it's kind of interesting. I don't think they're going to go into it, but it's another threat. And then, like what we just had that news earlier this morning too on Panama. that Panama's looking at canceling a deal with Hong Kong firms, or a large account with a Hong Kong firm to appease Trump on China's control of the Panama Canal. So you see these countries, some countries trying to appease and negotiate, and other ones like China, I think they're going to take a little bit slower action to try and respond or negotiate a better deal.
Yeah, I wonder what in the short term, I think it's going to benefit us, and I think that, Trump is going to win. I'm not sure what I have my doubts as to sort of the effects of this in the long term. It may lead to greater world instability, because if you think about it, since World War II, the world has benefited from effectively a form of Pax Americana. We've underwritten a lot of the stability in the world. And Trump and a lot of the folks who support him have been under the impression, Trump's articulated this really since the 80s, that they're not paying their fair share. There's a sense that, the rest of the world is benefiting from American um, protection effectively, but they're not paying their fair share. And so Trump is attempting to sort of renegotiate a lot of these kind of uh, I don't know, like the way that in which, the international order was kind of stabilized over the last 80 years. And I think in the short term, it will definitely benefit us. I'm concerned as to whether or not it'll lead to instability, like serious instability, like within, I don't know, 5 to 10 years kind of time frame. So, but in the short term, I expect this to be beneficial.
I do too. Another concern of mine is, like the energy independence. Um, so I don't know how much everybody else knows, but like our oil refineries we have in the United States, they were built to process foreign oil, heavy crude. So,
Yeah.
way back when, it's 70s, pre-70s, it costs more to drill for oil in the United States than what we could buy it for. So we set up our refineries to process like Venezuela's oil because we could actually import it cheaper than what we could drill it for ourselves at the time. So we haven't had any major new refineries built since like 1976. So our crude oil in the United States is very different. So it takes a different refinery to process that oil. So I believe we have primarily light crude in the United States versus like Venezuela and everywhere else where it's heavy crude. So if we're going to be self-reliant, do our own drilling, there's a lot more that goes into that. We'd have to build some new mega refineries, which takes time. The cost of drilling in the United States is also a big factor. So the price per barrel has to sustain a certain amount for it to sustain companies to drill in the United States. So if it gets too cheap, they go out of business. We've seen this back in, I say, 2007, 2008
Well, also
with the Obama
2014,
administration.
also
What's
from
that?
2014, there was a period of 2014 to 2017 where a whole bunch of E&Ps went bankrupt because Saudi decided to flood the markets with oil. I don't know if you remember that, but
Yeah.
oil was like at 100 for like a while, and then it's just like they there was a big OPEC meeting. Saudi decided to increase production. Oil dropped to like $35.
Yeah.
Yeah.
And at that point, if you're a driller, you know, you're operating at loss. You can't afford to drill and pull oil to the ground at that price. It costs you money. So you see these smaller, operations go out of business, and it's happened repetitively. So it used to be the standard for them to be profitable or to stay in business was around 75 bucks a barrel. So my concern is, if we start getting toward lowering it, if that's the case for energy independence, if we get to 50, $60 a barrel or maybe lower, how can we afford to drill our own oil? So that's another concern of mine.
Yeah, no, that's a very good concern because oil is a global commodity, and there's roughly about 104 million barrels produced and demanded per day, roughly. And it's the market is more or less in balance. I mean, there are some sort of storage facilities, but the best and cheapest storage is to just keep it in the ground and not drill it in the first place. Um, and so, you know, you have to look at sort of what the marginal cost of that last million barrels of production is. And so, whenever we have these spaces where there's like oil experts and, a lot of guys from, for those of you guys that are on Twitter, there's a group of Canadian oil guys called they call themselves the Canadian Oil Mafia that, follow this stuff very closely. And they roughly estimate that the marginal cost of production world oil is roughly between 65 and $75. So once you begin
That's,
to drop below that level, that last million barrel stops producing. Actually, that last million barrel is like probably way more than that, but call it the last 5 million barrels. That marginal cost of production and where they break even is roughly between, call it $70, which is right where it is right now. If you drop below that, a whole bunch of those people just stop producing, and you lower supply. And so then that automatic, over time it brings price back up. So that is an issue. Yeah.
it
And
definitely
and
is.
and Saudi is the sort of swing producer in the world because they have roughly between 3 to 5 million barrels of swing production that they can kind of bring online, and their cost of production is about $10. So they have a huge
Yeah,
benefit
it's
there.
much greater in the United States.
Yep, yep, yep. Mm. So let's see, we have some questions. Let's see, do you want to take any of these, Milk?
Yeah, yeah, I think we can take some of them. I think
You want to take a look?
Roblesh was asking, is it accurate to say that news is just a catalyst of pre-existing positioning? There's huge truth in that. So even in these huge catalyst moves, kind of like I was talking about a little bit ago, we're looking at these and positioning matters. So even when it seems random, it does have the order and structure to it.
I'll
Hopefully
give
that
you like
answers your question.
I'll give you like a clear-cut view of that. So imagine a situation where the news is everything. So imagine there's a biotech stock where um, they're in clinical trials and it's uncertain as to whether or not their product works and or doesn't work. And let's say they come out with news that says that it does work. So, if it does work, the stock, let's say it's at $10, it's going to go to like 30 or $40, and it would do that instantaneously. However, if you're in a situation where there's a huge amount of, let's say the short interest is massive in that one, you're going to get even a greater uh, sort of price movement up, right? So, let's say in a fair market, it would go from like $10 to $30. But if there's a huge amount of people that are already short, it could go to like $90, right? In that situation, because you have, in addition to news, you also have a massive squeeze.
Hmm.
That's the way I kind of think about it. Is that kind of how you think about it, Milk?
A, a little bit, yeah. I mean, it's more to me. It's more about seeing in the auction, where's that value at, and where have I seen, other large participants position prior. So you see it as a reactionary of those positions consistently day in and day out, even in these large catalyst events.
Good stuff. Any other questions you want to take?
I think Lim said, could tariffs result in a black swan type day/event depending on response? Or could we just look at a macro short economy shift, more supply side than demand side, and keep up with that? So there's always a potential for a black swan, but in this day and age, it's less likely from learning from previous situations that have happened. Typically, like a black swan would be resultive of over risk leverage in bigger firms. Let's say Vanguard, they have 10 trillion assets under management, if they went outside their risk parameters and we had something large happen, that could result that. But we've learned quite a bit from the past. Banks used to over lend in some situations, like long-term fund. That was a big issue when that happened. But we had like BlackRock come in and you know take care of some of that. So they've kind of learned. There's some old things that have happened, so I think it's a lot less likely. I don't know. What do you think, MG?
I agree with you on that. I think that the tariff news is really like, again, in order for there to be a true black swan, I agree with Milton that there has to be some sort of leverage involved. So some sort of credit event, which is usually, some sort of like either direct credit, like within the banking system, or somebody who's incredibly levered, who's over their skis. Um, and I'm not seeing that right now with tariffs. I don't see people having a massive position there. But let's go to the last potential black swan event, which would have been Silicon Valley Bank and First Republic and all those banks that sort of were in trouble in early 23. So in that situation, there was this notion that, oh my God, these banks are going to go under. There's going to be a fire sale. They're levered quite a bit, and a whole bunch of depositors are going to lose their money. It's going to, and then it's going to cascade into more and more banks having to fail. And the government kind of came in really quickly and plugged that up. And so once that actually happened, I think it was like Silicon, then Signature Bank, Silicon Valley, then Signature Bank, and then First Republic. Once that actually happened, even though there might have been other banks that were affected, more or less people felt like that black swan event was off the table because the government had a program or a policy in place that would sort of ameliorate that kind of event happening. So when I think of a black swan event, I think of a situation where someone's just way over their skis and something crazy happens. So right now I'm looking at like, I don't know, like, some sort of like geopolitical event, like some sort of terrorist action or some sort of like war starting as sort of like the major black swan events. Tariffs seem to be tit for tat, back and forth. They seem to be slow enough that people can kind of respond and position enough in time so that it's not really a black swan. I don't know. What do you think, Milk?
I fully agree with that.
Yeah.
Yeah, the tariff news, I don't think would be a catalyst for a black swan. It would take something catastrophic or way over leveraged in a big fund or bank or something.
Yeah. Yeah. Anything else? Because I think we're hitting that 1 hour mark here.
Um, Jay Banth asked, what are your main influences during massive news volatility? Still positioning or strictly what you see going into live time? There's positioning macro, big picture. It's just like having a book. You read the cover, you kind of know what the book's kind of going to be about. You can read the chapter headings, so you kind of know the structure of the book. Now, when it goes into these large news volatility events, positioning does absolutely matter. And then we want to look at the micro, what's transpiring in that moment. Like, are sellers or buyers interacting differently? Like when we're looking at the book, the liquidity in the market, who's pulling what, who's being active, who's being passive. And typically you can start to read those behaviors when we get those large data dumps or news events. So it takes time to kind of learn to read that and having, the right data and setups, but you can absolutely, take advantage of that.
I've noticed that too, like when you have like when I've looked at your charts, sometimes there's like these huge deltas, right, that you see
Hmm.
on the right. But obviously you have to interpret that in context, right? You can't just look at them unconditional to what's been happening before. I suspect that you interpret those differently based on how we got there, right? There's a path dependency to interpreting those deltas. Is that correct?
Correct. So essentially, like what we're looking here, 4850, you see a lot of large effort from sellers, trying to cap the session here. And obviously they're having little to no reward to maintain that. So kind of the most effort in the session has been 4850. So, we start to see those efforts in the market. So that's kind of responsive to what I was talking about, but there's a little bit more to it. But you see these quite often, and they start to become actionable, especially when we get near highs and lows, or by previous positioning, like what we have on pivots, and my seller's objectives and buyer's objectives. They start to become highly actionable because you can pair these data sets together to read the narrative.
Right, right. And so that kind of jives with what you hear from a lot of really good traders, where they just say, looking at the screens and the more time you spend just sort of looking and being really observant makes you better, because I guess over time, it's kind of like a deep learning model. The more data you have, the more context you develop, the better you become at predicting the next token in deep learning language. So that's kind of what's going on here, I suspect.
Yes, that's exactly representative of that. Like large language models, the more situations you have, the smarter it learns, the more it knows. If then that happens, you know the responses, or in a higher degree of probability.
Correct, correct. I think that's it, right? Do we have anything else?
I believe that was all. I don't see any other questions in
You don't
chat.
see anything else? I think that was pretty good. I learned a lot. And any final words, Milk, with regards to what you think? Just be very tactical. Is there any major strategic biases that you might have, other than I'm just looking at like the wave 20 for most of these things, and it looks like it's still bullish on SPX and Qs. Um, and any other major kind of ideas that you want to kind of put out there?
And it depends on what kind of trader you are. If you're more intraday swinging or swinging intraday, it definitely reflects on how you perceive the information. If you're a scalper, you're not going to be looking at how someone would swing trade. So kind of
Correct.
identifying and sticking to that. If you're kind of a bigger picture, don't let the volatility kind of skew what's going on. You start to factor things, but you're not going to want to be just responsive to what's happening. If you're, kind of bigger picture intraday, it's obviously different. You can manage risk differently. A lot of the guys I work with, they kind of layer out of positions. When you start to identify these higher confluence zones, you know what to expect. You can take quite a bit of a trend trade instead of hopping in and be like, okay, I'm going to take a quick 2 points or quick 10 points. You know where your risk lays underneath. So when we know we're going to aim towards like pivot, if sellers lose their positioning here, well, now sellers are off sides, just like you can see here. That was their objective, to maintain and hold for the session. Pre-market, they lost it. We back tested, and we're forever into the trend. And it all depends too on your perspective, right? If you're looking at the grand scope of the day, you know what to kind of perceive of, okay, so buyers are in full control above. Well, when we get up towards pivot and up towards my other marker that I had for the overnight, sellers are in control below. So having that picture instead of just always in between trying to get, just a couple points is going to help you, manage and be able to see that picture, big picture. So trend days are always going to be, your best performers. So learning to initiate and put risk on at those potentials is going to be your best time to do so. So kind of expanding your knowledge base and testing those. As you can kind of see, like if you go through and review like my Milk Alerts channel, I mean, I have what, 2, 3 years worth of data in there. So I mean, tons of study material. You can see this over and over and over again.
That's fantastic. That's fantastic for the folks that are kind of, as you can tell, much more. I look at the Wave 20 primarily on the daily. So it's, I'm looking at like, month long, multiple month long type trends typically. So it's a different time frame, but similar methodology. So that's much appreciated.
You're welcome.
All right, guys. Well, listen, this has been very helpful. Moki, I want to thank you for setting this up. Milk, thank you for taking your time out and engaging with the community. This has been really helpful for me. I'm not as engaged in this community as much as I was before, but I definitely read a lot of stuff. I definitely use Russell's tools, and it's very impressive to see kind of what Bigun and Ragav and all these guys have developed over the last year or so. So it's pretty impressive, you guys.
Well, thank you for helping hosting this, MG. It's always a pleasure with you.
Definitely. Have a great day, guys, and good luck. Good luck trading out there.
All right, I'll see you guys in chat. Take care.